Good morning and welcome to Thursday's regulatory briefing series sponsored by Virtual Compliance Management. We are glad that you could join us for this session, Regulations that will take effect in 2016. My name is Cheryl Kelly and I will be the moderator. We know your time is valuable, so each third Thursday of the month we design these brief sessions to cover key regulatory issues in just 15 to 20 minutes. During the sessions, all participants' lines will be muted. We'll be taking your questions at the end of the session, and we encourage you to interact with our speaker, James DeFrance, by typing in questions in the chat window of join.me by clicking the second green bubble on your screen. If you find you are unable to use the chat window, simply refresh your screen. James will be answering and addressing all questions at the end of the briefing. We'd love to have you connect with us and keep the conversations going beyond today's event, so please email us questions in case something comes up that you didn't think of during the session. You will be receiving an email that will contain a recording of today's event, so you can review any material or share with other officers at the bank. Now, I would like to introduce the facilitator for today, James DeFrance. James DeFrance is a consumer and real estate lending compliance specialist and a certified regulatory compliance management and anti-money laundering specialist with more than 30 years of experience in the banking industry. He has served as a senior compliance examiner at the Fed in San Francisco and as an analytical manager at the Office of Thrift Supervision, as well as a commissioned national bank examiner at the OCC. And now, I am pleased to give the floor to James DeFrance.
Thank you, Cheryl, and good morning to everyone. Good afternoon to those of you who are on the East Coast. Just a reminder, we do these briefings every third Thursday of the month at 10 o'clock Pacific Standard Time. We invite you to invite any of your staff to these because they are free. We have a number of topics that we've already scheduled, but if you have ideas for topics, please let us know, and we'll try to work those in. Today, we're going to talk about regulations that will take effect in 2016. But I should point out to you that it's not just regulations. It's important to pay attention to regulatory initiatives of the regulators. As Cheryl mentioned, I'm a former regulator. I like to consider myself a reformed regulator, but I still think like one. So let's get into it. In the financial industry, the New Year's tradition, it's a bit different than other places. Instead of watching the ball drop down in New York, we anticipate new regulations. It's just the nature of the beast, I suppose. Now, in 2016, the good news is, as far as regulations are concerned, the list for new regulations is relatively short. There's really sort of two and a half here. There are the flood insurance regulations, Reg Z, and TRID is the one that I'm calling the half. So there's new flood rules. Reg Z has some really interesting stuff in it, and of course, TRID has begun in late the last quarter of 2015. But remember, as I said before, it's not just the regulations that we need to pay attention to. It's also the regulatory focus. And as we get through this presentation, you'll find that some common areas appear. These are going to be fair lending, UDAP, CRA, and a portion of Regulation B, in particular, spousal signatures. We'll talk a little bit more about that. These are some of the common themes that we're seeing. In the BSA area, it's clear that due diligence is going to be emphasized. We've gotten away from Operation Choke Points, but we haven't totally gotten away with it. And what you're going to find is that the regulators are really going to focus on this idea of due diligence of your customers. The first significant regulation for 2016 are the flood insurance rules. And the thing that I want to point out the most is the new rule for detached structures. This can really be quite a change. Now, remember, this only applies to loans where a residence is taken as collateral. But those of you who experienced the pain of flood insurance and having a finding or a violation because there was a tool shed on the property that wasn't properly insured, that's gone away. The bottom line is now, is if it's a residence, you have to get flood insurance on the residence, but not on any of the detached structures. So that tool shed or that lean-to that's on the property does not have to be covered by flood insurance anymore. Having said that, be wary of safety and soundness considerations. So suppose the detached structure is something like a greenhouse or something that's very valuable. It's possible that regulators still might want you to have flood insurance on it simply for safety and soundness considerations. Another rule that's changed is on the force-placed insurance. So one thing that's been made clear is when a lapse actually occurs. It's clearly defined now as the date the insurance policy ends or the date that you find out that the amount of insurance is insufficient. That's the first date that you can actually now, under these new rules, start charging the customer for force-placed insurance. You do have to wait. You still have to wait the 45 days to apply, force-place the insurance, but you can charge them going back to that first date now. For most of you that are tuned into this briefing, the third rule under the new flood rules is probably not going to apply. If you're an institution that's had less than $1 billion for the last 2 years in assets, then this escrow rule is not likely to apply. But there is a rule that says that for those institutions that are over $1 billion, who've been over $1 billion for the last 2 years, all loans in a flood zone must have the premiums escrowed. As with all things with regulations, there's one other exception too. If you're an institution that requires escrow on all of your mortgage loans, then this escrow rule does apply regardless of how big you are. So if you're one that always requires escrows, then you must also escrow the premium on flood insurance. We have a lot more information about this on our website. We have a 3-part blog where we talked about each of these rules specifically. The next area is Reg Z, and in particular, this qualified mortgage exemption. One of the things the regulators are trying to do is to create a market for non-qualified mortgages. So if you're a small lender, and in this case it means less than $2 billion in assets, and you do less than 2,000 mortgages a year, you can actually make non-qualified mortgages and still have qualified mortgage protection. What's the catch? Well, there's always a catch where regulators are involved. The catch is if you make these loans that have, for example, balloon payments or greater than 43% income, you do have to hold them for 3 years before you can sell them. So the good news is you certainly can make these loans, and they're not qualified loans that have qualified loan protection. The bad news is you have to hold them for at least 3 years. There's a special emphasis on underserved and rural communities that the regulation talks about that really expands your ability to do this. So those are the 2 significant regulations. But now let's talk about some of the regulatory initiatives. Here's the thing. When regulators start a new initiative, it can have the same effect as a new regulation. For example, suppose regulators decide to de-emphasize looking at the amount of flood insurance that you've gotten on loans, but instead emphasize notifications. Some of you may have experienced this. One year, everything was fine. You got a good rating on flood insurance. The next year, you've got numbers and numbers of findings and problems. And a lot of it is because what's been emphasized. The good news is each of the regulators publish an annual report that talks about what they're going to emphasize in the upcoming year. The OCC is probably the most straightforward of all of these agencies. And as you can see on the screen, the first thing they said is they're going to engage in evaluating adequacy of compliance risk management and assessing effectiveness in identifying, responding to risks posed by new products, services, or terms. Cheryl pointed out that I'm a former regulator, but I still speak regulator, and what that means is they're going to really focus on the risk assessments that you do before you offer new products. Of course, they're going to continue to look at TRID, and all three regulators have released the exam procedures that they're going to use when looking at TRID. A good idea is to take a look at what the exam procedures are so you have a good idea of what they'll be looking at when they come into your bank. Flood insurance is always going to be an issue. It's one of those things that regulators will always look at, and it's one of those things that no matter how hard you try, something will be wrong, but not to worry. One area that OCC is going to take a look at that's unusual is the Service Member Civil Relief Act. That's one of those that tends to fall through the cracks when you're doing your compliance review. So be aware that they're actually going to pay particular attention to it and focus in this area. Of course, fair lending and the Community Reinvestment Act are areas that OCC says that they're going to focus on in 2016. Here's a quick word about the future, by the way. Remember that Dodd-Frank requires that banks will soon start keeping track of lending to minority and women-owned businesses. So it's a good idea to take a look at what your fair lending program is today, your CRA program is today, and start thinking about the fact that you're going to have to start collecting more information, especially about lending to women-owned businesses and minority-owned businesses. The Federal Reserve has said that one of the areas they're really going to focus on is Reg C, the HMDA-LAR. By the way, the reason that they really focus on this so much is because the LAR itself is used to do all of their research. It's the LAR that they use to put together their database to do research on everything from trends in lending to discrimination and so forth. And that's why they're such sticklers about making sure that the LAR is accurate. And they yell at the other regulators, too, to make sure they're doing the same thing. So it's not that they're just being jerks. It's that this really is important to get the LAR straight. The Federal Reserve in particular said they're going to pay attention to the spousal signature rules of Reg B. For those of you who are largely commercial lenders, this is an area that when I was a regulator, I used to always focus on. It's one thing to say that you don't do a lot of consumer lending, but remember, Reg B applies to all loans, so it also applies to consumer loans. Be careful when you get spousal guarantees when you're doing commercial loans, because that's an area where this Reg B spousal signature rule comes into play quite a bit. Of course, UDAP is always going to be an issue, an area that the regulators are focusing on now. This comes up in flood insurance. Just be careful. If your customer has more insurance than is required by the fair market value of the property, make sure that you're letting them know that it's not because you've required them to get excess insurance. Have documentation that shows that you recognize that there's too much insurance and you did not ask the customer to get more than the fair market value of the house. Of course, UDAP also covers advertising, overdrafts, and another area they said that the Federal Reserve said that they're going to look at are fees on revolving loans. The idea here is if fees seem excessive or if there's more than one type of fee and a customer may be confused, there are possibly UDAP issues, so be careful. The FDIC wasn't particularly clear on what they said they were going to do, except, of course, they're always going to focus on flood. Fair lending comes up once again, Community Reinvestment Act, and UDAP. So they're, of the agencies, they weren't as specific. They said they're pretty much going to keep on doing what they've been doing. One thing the FDIC announced was that numbers of staff have been reduced. So the good news here is that it's likely that your exam schedules will be longer than in the past. There'll be a longer time from one exam to the next. Now, the CFPB, of course, regulates the really large institutions, and they don't directly impact some of us, but what they tend to look at tends to impact what our regulators look at. So they're going to look at compensation plans for lenders, making sure that there's no incentives to be aggressive in the way lenders are compensated. So it's okay to have commission programs, but there has to be some sort of levers to make sure that lenders aren't unnecessarily aggressive. They're going to pay close attention to the ability to repay, pay, and qualified mortgage rules. Again, they're really encouraging smaller institutions to take a look at the exemption. CFPB is, of course, going to look at TRID and see how it's working. It's their rules, so they want to make sure that it's working and people are particularly in compliance with it. Again, I suggest that you take a look at the exam procedures that all of the different regulatory institutions have published. And then they're going to take a look at marketing service arrangements. They're concerned about third-party processors, people who are going to sell sort of side products for banks. They're taking a look at those and making sure that all the things that are offered in those things are actually true and don't rise to the level of UDAP. In the area of BSA, the big area here is going to be customer due diligence. FinCEN has asked for and received comments on their due diligence rules. They've also done a report to explain why additional due diligence would not create an undue burden of cost on institutions. And so they're really going to be taking a look at this area. They're going to be making sure that you're taking a look at beneficiaries of an account, especially if the beneficiary is not a signer of the account. Operation Choke Point went away, but it still remains in some respects because the regulators are going to be taking a look at enhanced due diligence for high-risk customers. The thing here is that you have to know all that you can possibly know about your customers and what they're doing. Your ability to monitor the customers has to match what the customers are doing. They got away from this idea of getting information on your customers' customers officially, but I'm telling you, as much as you can, know what your customers' customers are doing too. At least know why it is that your customers are doing what they're doing and who they're relating to. The more you know about your customer, the better off you are. So, here we go. Flood insurance is always going to be a focus. Remember that the qualified mortgage rule presents some opportunities for small lenders. Please pay attention to fair lending and CRA this year. Start preparing for a future where you're going to collect additional information. Remember that UDAP is always, always, always lurking around every overdraft, every new product, even products that you cancel. There's always the possibility for a UDAP concern. And last but not least, due diligence is always going to be a part of BSA, and it's going to be an even greater part of BSA going forward. Just want to do a quick commercial for you. We have a product that we are very, very proud of. It's called VCM Connect. It's a subscription service that works as a resource for your compliance staff. So there's a great deal of information, forms, even some videos that help in the areas of compliance. We encourage you to go to our website to get more information in that area. And now I'll turn it back over to Cheryl for questions.
Okay, thank you, James. And our first question is, what's the best way to get information about what our specific regulator will emphasize?
There's two best ways, actually. I'll answer it this way. Each regulator publishes an annual strategic plan, and in that plan, they talk about what the emphasis for the upcoming year will be. Most compliance folks don't really have time to read that whole plan, so a second best way to do it is literally to call your supervisory agent and just simply ask them, what areas are you going to focus on this year? Tell them that we're preparing our year and we want to be ready for stuff, so let's have a conversation about what you're going to focus on this year. It serves two purposes. I'll tell you what, as a former agent myself, it really gave me a good impression about the institution that was calling me because it said they took compliance seriously. And you'll get the information that you need right away.
Okay, and the second question is, does the CFPB impact me at all?
Yes. Even though it doesn't regulate smaller institutions directly, I'm telling you now, whatever the CFPB focuses on is surely to be a focus of the other prudential regulators sooner, if not later. So pay attention, those of you who have automobile lending, either direct or indirect auto lending, that's going to be a focus of CFPB. They apparently are very, very concerned about the fair lending implications of that. So that's going to be an area of focus. And so soon, it'll be an area of focus for the FDIC, the OCC, and the Federal Reserve. So indirectly, yes, they impact you.
Okay, and our last question. What are some best practices for due diligence?
When you're talking due diligence and BSA, some of the best practices are to just make sure you understand exactly the business plan of your customer. If you don't understand it, if you can't explain it to somebody else, by the way, then you don't understand it. And if you don't understand it, then they ought not be your customer. The bottom line is you have to know what they're doing. And so when you're looking at their transactions, the transactions have to make sense based on what it is they're supposed to be doing. If you have a customer who sells bicycles, even if they're high-end bicycles, if they're sending wires to Uzbekistan, it really doesn't make any sense unless there's some supplier of high-end bicycle parts in Uzbekistan. So that's the thing. You just have to know exactly what it is the customer is doing, how they're supposed to be doing it, and then that way you can monitor them properly. That's really the whole crux of the issue with due diligence.
Okay, and as I said, that was our last question. And on behalf of James DeFrance and the team at Virtual Compliance Management, thank you for joining us and have a wonderful day.
Thank you.